Why do some currencies seem so powerful? Have you ever wondered why your dollar stretches so much further in some countries but barely gets you a coffee in others? It's not just about geography. Understanding why currencies have different values can unlock powerful insights for investors, travelers, and anyone serious about building wealth. In today's video, you'll learn the real forces that drive currency values and how mastering this knowledge can give you a major financial edge. After years studying global markets and economic trends, I'm excited to break it all down for you. The hidden forces behind currency strength. Imagine planning a trip abroad, only to find that your money doesn't buy nearly as much as you expected. Or investing internationally, only to watch your returns disappear because of currency fluctuations. These situations aren't rare, they happen every day. Many people feel frustrated when they realize that the value of their money can shift simply because of where they are, or because of changes in global events they have no control over. It's easy to feel powerless. But what if you could understand the hidden forces behind these changes? What if you could anticipate or even take advantage of currency movements? Whether you're investing, traveling, or simply trying to protect your savings, knowing why currencies rise and fall is essential in today's interconnected world. And the truth is, it's not as complicated as it seems. Once you understand the basics, you'll see the world and your money differently. Currency Value 101, the real drivers. In this video, we'll break down the 9 key factors that shape a currency's value, from simple supply and demand, to inflation rates, interest policies, trade balances, and even political stability. We'll also explore real-world examples, showing how currencies react to economic crises and global trends. By the end, you'll have a clear understanding of why different currencies are worth different amounts and how this knowledge empowers smarter decisions. How the currency market actually works. At the core, the value of any currency is determined by how much people want it and how much of it is available. This is the classic law of supply and demand. If a currency is in high demand and limited in supply, its value rises. If it's oversupplied or nobody wants it, its value falls. Simple, right? Yet behind these simple mechanics lie powerful economic forces, shaping the strength of every currency worldwide. Why GDP, jobs, and growth matter for currency. The foreign exchange market, or Forex, is where currencies are bought and sold daily. Here, supply and demand dynamics are in constant motion, driven by millions of transactions worldwide. When investors, businesses, or governments seek a particular currency like the US dollar, they increase its demand, pushing its value up. Conversely, when demand falls or too much supply floods the market, the currency weakens. Economic reports, trade deals, and even political speeches can instantly change how much people want a currency, making the Forex market one of the most dynamic and fast-moving markets in the world. How inflation quietly destroys currency value. A country's economic health is a major driver of its currency's value. Strong economies tend to have strong currencies. When a nation's GDP is growing, unemployment is low, and productivity is rising, investors see it as a safe and profitable place to move their money. They buy that country's currency to invest in stocks, bonds, and businesses, increasing demand and driving up the value. On the other hand, high unemployment, shrinking GDP, or a sluggish economy can erode investor confidence. People start moving their money elsewhere, weakening the currency. That's why financial news often talks about economic indicators like GDP growth rates, employment numbers, and consumer confidence. They're not just statistics, they're clues to understanding how a currency might behave. Why central banks hold so much power. Inflation, the rise in prices over time, directly impacts a currency's value. When inflation is low and stable, a currency tends to hold its value or even strengthen. But when inflation rises too fast, the purchasing power of a currency drops. People need more money to buy the same goods, making the currency less attractive domestically and internationally. Extreme inflation, like hyperinflation, can completely collapse a currency's value, as seen in Venezuela and Zimbabwe. That's why central banks work hard to keep inflation under control. It's not just about prices, it's about protecting the nation's financial stability. How global trust builds currency strength. Monetary policy, especially interest rates, plays a powerful role in currency values. Central banks, like the US Federal Reserve, adjust interest rates to influence inflation and economic growth. Higher interest rates make a country's currency more attractive to investors. Why? Because they offer better returns on savings, bonds, and other investments. As demand increases, the currency strengthens. On the flip side, when interest rates are low, investors may look elsewhere for better yields, weakening the currency. But it's not just about the current rate, expectations matter too. If markets believe rates will rise in the future, they may start buying a currency now, pushing up its value ahead of time. This is why every statement from a central bank can move global markets in seconds. Why trade makes or breaks a currency? Global investors don't just look at numbers, they look at trust. A country may have resources and potential, but without political stability or reliable institutions, its currency may still struggle. Unrest, corruption, sudden leadership changes, or unpredictable laws make investors nervous. They'll pull their money out or avoid investing at all, which weakens demand for that currency. On the other hand, stable countries with transparent governments and strong legal systems attract confidence. That confidence becomes demand, and demand fuels value. In short, the world rewards countries that are steady, predictable, and safe to invest in. Why countries stockpile foreign money in gold? A country's trade balance, the difference between exports and imports, also shapes its currency value. When a nation exports more than it imports, foreign buyers need to purchase its currency to pay for those goods. That increased demand can drive the currency up. Conversely, if a country imports far more than it exports, it's constantly sending its currency abroad to buy foreign products. That can weaken its value over time. Trade surpluses support stronger currencies. Trade deficits, especially large and long-term ones, can put downward pressure on them. It's a constant flow of money that directly affects demand. How the US dollar dominates global finance. Countries often hold large reserves of foreign currencies in gold. But why? These reserves act as financial armor. They help stabilize a nation's currency in times of crisis or uncertainty. If a country's currency starts to fall rapidly, the central bank can use its reserves to buy back its own money, supporting its value. Gold also plays a symbolic role. It's seen as a store of value that builds confidence. The more reserves a country has, the more trust it inspires internationally, and trust can translate directly into a stronger currency in global markets. How currency strength affects your portfolio. Some currencies hold a special status on the world stage. They're called reserve currencies. The US dollar is the most dominant one. Why does this matter? Because central banks, companies, and governments around the world hold dollars for trade, debt, and savings. That constant demand keeps the dollar strong even during times of uncertainty. Being a reserve currency brings major advantages: lower borrowing costs, strong global influence, and economic stability. Other currencies like the euro, yen, and Swiss franc also play reserve roles, but none match the dollar's reach. This unique global demand is one reason why the US can run trade deficits for years. The world still wants dollars. It's a position of privilege, but one that must be backed by trust and economic strength. Why understanding currencies makes you smarter with money. When crisis hits, whether economic collapse, political turmoil, or war, investors flee. And one of the first things they drop is the local currency. Take Venezuela, for example. Years of hyperinflation and political instability led the bolivar to lose nearly all of its value. People began using US dollars just to survive. Argentina, too, has faced repeated currency crashes due to debt defaults and lack of investor confidence. When trust disappears, so does the currency's strength. People want to protect their wealth, so they exchange it for something more stable, like the dollar, euro, or gold. That flight to safety drains value from weak currencies and inflates demand for stronger ones. Crises don't just shake economies, they can crush currencies. Take the next step in your financial journey. So, what does a strong or weak currency actually mean for your money? A strong currency gives you more purchasing power abroad, great for travelers and importers. It also attracts foreign investment, since returns are more stable in a solid currency. On the other hand, a weak currency makes exports cheaper and more competitive, which can help local industries grow. But for investors, weak currencies are a risk. If you invest in a country whose currency declines, even strong stock gains can be wiped out when converting back to dollars. That's why currency stability is so important. Whether you're investing globally, running a business, or planning a vacation, the value of a currency touches everything. In the world of finance, currency strength is more than just numbers, it's influence, trust, and opportunity. One step closer to financial freedom. Now that you understand what drives currency values, you're ahead of most people. Why does that matter? Because financial knowledge is power, and in this case, global power. Currencies are more than paper or digital numbers, they're reflections of entire nations. They represent trust, productivity, and choices made over decades. When you understand how currencies work, you can better protect your money, spot opportunities, and avoid major risks, especially when investing internationally. It's easy to overlook these forces, but they quietly shape everything from the price of your morning coffee to your long-term wealth. So the next time you hear the dollar is rising or a currency is collapsing, you'll know exactly what it means and how to respond. If this video opened your eyes to how currencies really work, don't keep that knowledge to yourself. Like and subscribe for more financial insights that actually matter. We break down complex topics into simple, practical lessons every single week. And let us know in the comments, which country's currency do you think is the most underrated right now? Join the conversation and let's grow smarter together. Remember, financial knowledge isn't just about numbers. It's about understanding the forces shaping the world around you. And today, you've learned the key factors that drive currency values, one more piece of the puzzle to help you navigate your financial journey. So, take action today, whether it's learning more, investing wisely, or simply understanding the markets better. The road to financial freedom starts with small steps. Let's keep moving forward, one step at a time.